what is the state of crypto and the Web3 environment. So maybe we can get started with a little bit introduction about Chainalysis for those people who may not have heard of it, which will be very rare, I think, at this point. But we'd love to learn more from you.
Awesome. Well, thanks for inviting, and a pleasure to talk here. So a little bit about Chainalysis. Chainalysis has been around for 8 years. We are a company specializing in building data on top of public blockchains. So we basically analyze all transactions in public ledgers, have machine learning algorithms grouping them together so you can assess whether two transactions are done by one entity or two different entities. And using that algorithm, we can then figure out what the different entities are. And suddenly you have this knowledge graph of what crypto is about. And when we started doing that 8 years ago, it was kind of niche. And today it's extremely important because we see a lot of wealth being moved around on public blockchains every day. And it also means that we can inform a lot of different things in the crypto economy. And it could be anything from, of course, market movements, but also, and that's our main, I would say, main revenue drivers as a company today, is on the investigation side for government. So government, that can be law enforcement, it can be intelligence agencies, it can be tax, it can be customs, a lot of other government entities wants to understand what happens in crypto. And sometimes they might have a suspect they need to investigate, so they follow the money, can figure out where the money goes to, and figure out how to identify the suspect, for example, or figure out what happened there. Also, big part of our revenue is compliance. We work with 800 crypto businesses in the world that all send data to us, and that build out the mode of data. On the public sector side, I didn't say that, but we have around 200 public sector institutions in 50 countries in the world. So it's a lot of different countries that are part of the Chainalysis family today.
Great. Well, thank you so much for that introduction. So maybe we can start today's webinar with the elephant in the room. Recently what happened in the crypto world. Definitely it has impacted a lot of people. So would you maybe give your views on what do you think will be the effect of the fall of FTX, and what's your take in us? Where do you think things went wrong, and what do you think this leads to us, given terms of like user adoption, caution, and industry regulation?
Yeah, these are great questions, and of course all of this is somewhat speculative today because it's hard to understand like what will actually be the outcome. But I think maybe it's useful to do a throwback. What is that now? Probably 8 years ago, if not 9 years ago. 9 years ago, the biggest crypto exchange in the world was called MarketX. MarketX, in the summer of 2013, figured out that they had lost probably a lot of user funds. They actually didn't understand what had happened to them at that point, but they understood that they needed to get the money back because otherwise there would be a problem. So internally, in that reaction, they actually did something illegal. So they started to build a pump and dump scheme where they basically just used user funds to buy more cryptocurrencies, and that drove the price of Bitcoin up. Of course, that attracted a lot of users to the exchange, and that was the whole point, because if you want to avoid a run on your exchange or run on the bank, if there is rumors that you are out of money, then you want more users to jump in. So that worked for half a year. The Bitcoin price went to $1,000, and then MarketX crashed. Suddenly people started to withdraw funds, they couldn't do it anymore, and the money were actually gone. The main reason why the money were lost were actually not because of the pump and dump scheme.
Recording in progress.
That was more reaction. It's all good. It was more reaction to the fact that the money were gone. But now they had been stolen back then. They had lost like equivalent of $500 million, and back then that was a lot of money. So now the crypto industry went into a lot of like reckoning. We saw a lot of reactions to that. One of the reactions were what you call swift regulation. That means it happens 15 months later. And that's kind of the time scale of regulation. So when people imagine that regulators will jump in immediately it's like a year later. So that's roughly where the time horizons are. But the regulatory actions that were taken were, we saw in Japan where MarketX were situated. I worked closely with regulators back then in Japan, and I would say they were somewhat puzzled, but also interested. But what ended up being the case there was that they put VAT on Bitcoin and on crypto, which was like somewhat bad. They got removed later, so it was not that bad after all. And then there was a process going on in New York already where the bit license was being shaped up. And that means that the course of that got changed and became very much centric around consumer protection. So we got like regulation to prevent the new MarketX, and the good news about it is that FTX were not located in New York, so it kind of worked. But the bad news about it is that regulation in a modern world is different because consumers are today inherently global. They will act global and they will find products global. So the only way that you can actually protect consumers is to solve for two things at the same time. Number one is to attract the interesting businesses to your jurisdiction. And number two, once they're there, you ensure that their customers are protected by some framework around those businesses. That's actually hard, and especially hard in regulation. And if you look at the world today, that's definitely not the world of crypto when we see exchanges in the Bahamas and in Malta and in other jurisdictions that might not have the best resources available for financial oversight. So that was the story, throwback to what happened back then. So let's now move forward till today. And today we have like a somewhat similar situation. Earlier this year, it seems like FTX lost a lot of money on highly leveraged trading. So highly leveraged trading, it comes with a risk, and at some point you might lose a lot of money. That happens. The typical reaction is that you probably leverage more, but to provide leverage and gain back what you lost, you need some funds. So to solve that problem, it's not too dissimilar to what happened in MarketX. You dip into user money and hope that that can help you repair it, because that's a cheap loan that you can get that way. So they dip into user funds. They did it accounting-wise okay, because they basically issued a loan that was, they swapped it for FTT, which is a token that you can argue was worthless, but you can also argue it had a price. At least on some piece of paper and in a spreadsheet, you will have a price. And now you swap those things out, and suddenly you had money to buy for and try to recoup what was lost. It might have worked for a while. It might have worked forever. You never know. There might be other exchanges that manage to solve for a hole in the balance sheet that way. But anyway, it didn't work. And at some point, there was rumors out there that the balance sheet was only based on FTT. That got leaked by Coindesk, and then suddenly after that, it was within 5 to 10 days, and then people started to withdraw funds, and FTX got in a big trouble, and suddenly they had to file for bankruptcy. So it's that's where we are today, and then we can look forward and say what's going to happen from now on. What will regulators do? What is going to happen here? And that's again super speculative, but I think that there are two sides of this coin, right? So I think that number one is that people think, oh my God, that's yet another crypto thing. That's one reaction. I think the other reaction that's probably where I stand today is that this was just fraud, and that happens all over the globe, all the time. And it will happen again, both in crypto, but also in a lot of other industries, because that's just how it is. And that means that there's a lot of things to repair, but there's not a lot of things to change, because this will happen again. We can provide better regulation that can somewhat protect it. We can provide different guarantees and other things, and the industry can actually come together and do some of that. In the wake of MarketX, just to put things in perspective, I was at Kraken back then, and we did the first proof of reserve, and we thought everyone was going to do that now, and now 8 years later, no one did that, and everyone talks about proof of reserve, and I'm like, yeah, that's something people will do for a few weeks, and then that becomes like irrelevant. So I don't think that consumers actually care as much as we think they do. They forget very fast. So I think that's my likely outcome, is that most people forget about this. There'll be a new interesting innovation in the crypto space. people jump on that one, and then we will probably see something similar at another time.
Right. So I guess from last year, we were at Crypto Bahamas. We were, a lot of these events where it seemed like from a regulator's point of view, things were slightly looking up because SBF did spend a lot of time working with the government, probably one of the most well-known and visible donors for the election, right? Just curious, what do you think is going to happen in terms of regulatory changes after, now we're not just looking at, FTX, right? There are a lot of exchanges around the world that's being affected by this contagion. Almost, quite a few very well-known ones are shutting down. So, we're in the world of bailing out companies. On one hand, he was bailing out others, and now we're looking at, even bigger chilling effect. So what do you think is going to happen to global compliance, and also how is the government looking at this, given your exposure talking to a lot of the regulators?
So I think again the challenge with regulation is that it's only tied to a certain jurisdiction, and the world is global. So it's like it's the typical challenge, like say let's solve it, but you then solve it in New York, or you solve it in California, or you solve it in another part. And it might not solve that as much unless you can, as I mentioned earlier, actually manage to attract all the companies that consumers want to your jurisdiction and then regulate them from there. So I think that should be the mindset. But at the same time, cynically, it's like regulators also do this not necessarily only to protect consumers, but also to show action. And I think that's the two like things that fights against each other. And showing action is kind of easy, but actually protecting consumers is very hard. So what I think is going to play out is that we will see existing regulation being fast-tracked. And that's actually good. So you will see MiCA being fast-tracked in Europe, maybe slightly faster than otherwise expected. We might actually see that some of the regulation in the US gets fast-tracked as well. Some of the already things being worked on will happen there, probably with a few tweaks to them. But I think that's a likely outcome. But we will also see a lot of jurisdictions around the globe with literally little or no regulation around this. And we'll probably still see a lot of exchanges operating out of those jurisdictions even afterwards. So I think that you will see some changes, but you had actually regulated businesses that protected consumers' money operating out of jurisdictions, and they have not been affected. Coinbase has not been affected as an example, but still, well, a lot of people chose not to trade on Coinbase because they couldn't offer as many products and diversified products as other exchanges could operating out of other jurisdictions. So I think that's the real challenge here, to understand how we do about that. And it's really impossible to regulate things from a global point of view. So the only thing you can do is attract the businesses and regulate. Let's see what that happens.
Gotcha. So basically, we have a few questions being popped up by our audience here. One of which, we're trying to understand, who do you think are the winners and losers at this point? Obviously, it's hard to say, but we can see the initial Binance saga, right? And then we also understood that there was a little bit of almost kind of like a rug and pull situation, right? I believe many people had no idea this was about to happen, given, just weeks before, we saw a lot of activity, when we were having a conference in Saudi Arabia, FII, looking at Dubai, right? I mean, just days before the event, SBF was actually presenting at these conferences like nothing's wrong. Granted, the Terra Luna situation happened in the summer, right? So this was actually a few months before. So everything leading to that point, just curious, like if there, anything we don't know here, who do you think are kind of the beneficiaries of this event?
So I think if we look at it, what actually happened is that because like the schemes got leveraged out of like other people's money, to put it that way, then those who won already won, but they actually didn't know they did. So in the time where crypto went up to a higher price than it could have, everyone who sold at that time earned money on that. And that was the same if you go back to what happened in Mt. Gox when the prices got pumped up to $1,000. Everyone who managed to sell between 200 and 1,000 won. They did, because they basically got the benefits out of this. But I think that anyone who won in this game for the majority of this were basically just trying to do good trades and were succeeding. So that's how I see it there. Those who lost was, of course, like, first of all, those who got their wealth stolen, where someone used it to trade for, and suddenly they become a creditor instead of becoming a depositor. And that's those who clearly lost. There's a lot of money lost, and others who lost is clearly
recording in
Binance.
Progress.
We saw Binance had a lot of FTT. That was basically what they got instead of the position they had in FTX, and they are worthless now. So they definitely lost as well some funds in that setup. If you look at it from a political point of view, or like a company political point of view, who stands stronger today? I think it's hard to really say if there's really any winners here. You would say that, like, the regulated businesses around the globe should in principle win, but at the same time, you could also say that others less regulated businesses that operate more globally, they might stand to win because they have fewer competitors in the space. But then at the same time, we don't win by having competitors in crypto because it's so early and it's all about adoption. So I'm not even sure that there's like really any winners in the more like challenge between companies there.
Gotcha. Yeah. So as you can see, some our audience questions. As a dominant industry leader, what do you think about the market share now in terms of, where do you see advancement for Chainalysis? This is one of our audience questions. Would you
That's
like
a great
to
one.
take
Yeah.
on that?
Yeah. Totally. Because like we're an interesting business in the sense, and first of all, just to say a little bit more about Chainalysis, we never accepted payments in tokens, so we don't have any tokens on our balance sheet. We did a experimental investment in Bitcoin at some point for $1 million, and that's still there. And we have around that left, so it's not a lot. So we don't have any tokens on our balance sheet in any way, and all the payments we have is recurring revenue, software as a service that grows at a high growth rate year over year. And the business revenue is composed of around 60-65% of our revenue is government business, and around somewhere in the 30 to 40% is private sector business. On the private sector, it's typically crypto businesses that pay per transactions, and in the public sector, it's per seed. And the reason why I go into this explanation is that when I look at opportunities now, is clearly that we have seen customers from the public sector hurrying and getting licenses over the last few weeks. So we clearly saw that suddenly jurisdictions around the globe that were trying to see is something we need to look into, they could definitely see that this is important for them because they have a regulatory responsibility. So we clearly seen a tailwind in the public sector market from this. On the private sector side, I would say it's, what we have seen in other situations is that typically following a slowdown in the crypto space, you will see smaller players go out of business, typically the smaller players, and we will see a somewhat, how should I put it, a somewhat contraction pressure in the bigger businesses where they are a little bit more cautious around how they spend their funds. But at the same time, we typically don't see a slowdown in the number of transactions, but the growth of it slows down. So what our expectation is that a little bit of churn in the private sector, a slowdown in the private sector, but at the same time, a growth in the public sector. And then finally, what we also seen is that we have seen a lot of requests around investigations from creditor sides. What happened to my money? What happens here and there? If I want to run a case against here, there's lawyers who now needs evidence and needs evidence on chain. So we saw a pick up on on case revenue, like on services revenue as well. So these are like the things. So I would say neutral, slightly negative, but probably not just neutral in terms of our growth rate from here.